bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the February 10th, 2026 episode. If you're watching on YouTube, you can see that my guest this week is John DeJovine, a partner in Novogradac's Cleveland office. John is an expert in many community development tax areas. He has a special expertise, which is why he's on the show today, with historic tax credits. Those of you that have purchased our Novogradac Historic Rehabilitation Handbook probably know that John is the technical editor of that handbook. Talking about historic tax credits is always something that's near and dear to my heart. And it's not just because I believe in the significance of the preservation of America's historic heritage. It's also because that's where I got my start in community development tax credits. Way back, I can't believe this, in 1985, where I was working at a major accounting firm before starting Novogradac in 89 and worked with historic tax credits before the Tax Reform Act of 1986. And that's back when the historic tax credit was a 25% credit for historic properties, 20% for properties 40 years or older, and 15% for properties 30 years and older. So whenever I'm talking about historic tax credit, it always takes me back to those early days. But this podcast isn't about me reminiscing. John's joining us today to discuss what developers of historic properties should know about historic tax credits. And you might be thinking, that's a bit of a generic and general topic. And the reason why we're holding this episode, and this episode really is long overdue, is that historic tax credits is one area of our practice where we don't necessarily have continuous and repeat clients, in the sense that for affordable housing, we have lots of clients that are developing affordable rental housing with tax credits, and they do it year in and year out in various states. And then with the new markets tax credit, we clearly have clients that are focused on being community development entities and applying for new market tax credits and financing community development in distressed communities. And similarly with renewables and other areas, they're very focused on using a particular tool. Whereas when you look at historic tax credits, there are many developers out there that are focusing on renovating properties, and some of the properties are eligible for historic tax credits. And many times they've renovated a number of properties and haven't had a property that was eligible for historic tax credits. So we get a lot of these first-time calls. So that's what the purpose of this podcast is to give some advice to first-time developers. And in essence, what we go through today will be, in some sense, what John discusses with a developer of a property that hasn't used historic credits before and is considering it, has heard about it, and wants to know if the historic credits might be right for their particular development. That said, I do think we're going to cover a lot of items that even if you have experience developing with historic tax credits, there's some things to learn. So with that, let's jump right into the podcast. We have a lot to cover. So if you're ready, let's get started. John, welcome back to Tax Credit Tuesday. This is your fifth appearance. I appreciate you coming back.
Thanks, Mike. Amazing to say it's my fifth time. Appreciate you having me again.
Now, before we get into the details of what we're going to cover in the course of the podcast, please share with our audience what services you provide to Novogradac clients.
Sure, Mike. So I have a wide variety of audit and tax services that I do for historic tax credit, low-income housing tax credit, new market tax credit clients, as well as financial forecasting and consulting services. Much of the work I do is in the historic tax credit industry and items that we'll be covering today.
Thank you for that, John. Thanks for sharing some of the services you provide. Now, in the introduction, I mentioned that historic tax credit developers, the calls that we get are from developers who are often using historic tax credits for the first time. To that end, When do you think a developer who's heard about historic tax credits and someone has suggested them, or they otherwise are thinking it might be something they could use on a given development, when should they reach out to someone at Novogradac to discuss the potentiality?
Sure, Mike. So the answer is as early as possible. And if you're considering a historic tax credit development, there's really two calls you need to make as early as possible. One is to a historic tax credit consultant or architect who can help you with the National Park Service process and ensure your understanding, and will take the steps necessary to rehab your building in a way that'll meet those standards. And the second call is to Novogradac and to your CPA to help understand the impact of the historic tax credit, if your project can qualify, and then what that financial impact will be for the historic tax credit. And we're especially helpful for spotting potential issues and helping avoid pitfalls and maximizing the overall benefits that would be available to a historic tax credit developer. So I think it's very beneficial to have that call very early on.
Obviously, I couldn't agree more. And I think this is one of those areas, like with other the incentives that we work with, that you want to be dealing with professionals that have experience with historic tax credits, such as you mentioned, the architect or historic tax credit consultant. That's a critical part of the team, and your architect needs to have historic tax credit experience and working with the Department of Interior. If not, you need to get a referral, at least have a consulting architect that has that experience. And if they're not the ones who are your consultant, you then need to have a second one who works with the Park Service as well as your state preservation office. So the architect and the historic tax consultant, which might be one and the same, and need to have historic experience. Obviously, the CPA firm needs to have experience with the historic tax credit. And then similarly, your legal counsel need to have legal counsel on board that has experience and has closed a lot of transactions with historic tax credits. So it's critical. And people might be saying, well, of course you're going to say that, Mike. That's the services you provide. But I think the listeners know how critical that is to make sure you have someone who's very experienced and not doing it for the first time. Now, in preparing for the podcast, we did discuss that on that initial call that you might receive with the developer, one of the goals is to discuss some of the gating issues to decide, should there be another call? Are historic tax credits going to be right and even available for a given development, a given renovation project? So please, for the purpose of the audience, discuss some of the larger gating issues if a developer is thinking of using historic tax credits.
Sure. Thanks for that question, Mike. So when I think of the gating issues for historic tax credit developments, I put them in two general buckets. The first is the tax gating issues that may make a project qualify or not qualify altogether for historic tax credits. And the first one that comes to mind is the substantial rehabilitation test. You need to incur qualified costs in excess of your tax basis. So even if you have a historic project and you're going to incur a good amount of historic costs, if you recently purchased the property and it was for a high value, you may have projects that won't be able to incur QREs in excess of that basis and therefore may not qualify for the historic tax credit. So that's one of the initial questions that I'm asking the developer to make sure that they're going to check that box and at least be able to pass the substantial rehab test. The next is tax exempt owners and tax exempt participation in the deal. So the historic tax credit has certain tax rules related to tax exempt owners and tax exempt leases. And so if there are partners involved in the transaction that are REITs, foreign entities, governmental entities, those are considered to be tax exempt owners and can cause potential issues with generating the historic tax credit. There are ways to structure around those items, but a developer is going to want to be aware of how those issues work, affect their project, and then what is the potential cost to overlaying that on their historic tax credit development. So those are a couple of the initial just tax issues that I want to hone in on for developers and make sure they're aware of before we move forward. And then Other gating issues that I like to handle that I look at more from a financial impact and a marketability of their historic tax credit transaction. And those are, one, the size of the deal. So naturally, if you have a larger project that's going to generate more in historic tax credits, that's going to make obviously the benefit more beneficial. It's going to alleviate some of the costs that go along with going forward with a historic tax credit project. And if you choose to pursue a historic tax credit investor, it's going to make your project more marketable to those potential investors. And then the second gating item from a financial aspect that I like to address is the state historic tax credits, and ensure that if a developer is considering the historic tax credit, they've considered either applying for or what options are available to them from the state historic tax credit aspect. We've seen over the years the state historic tax credits continue to grow, and we're at almost 40 states now. You've got states now where really the financial impact of the state credits is even greater than the financial impact of the federal credit. Understanding those state credits, the availability of them to the project, and then how much more marketable that can make their project as well if they choose to pursue historic tax credit investors.
Great. Thank you for all of that. And one thing that I would just add is on some of the issues that you identified, I don't think a developer, and I'm sure you agree, should self-select themselves out without having a call with you or someone else at Novogradac first, because at first blush, to those that aren't as expert, it might seem one of these issues can't be overcome. But when you end up talking to a professional like John, you can end up identifying ways in which what you thought was something that you couldn't overcome, there are structuring alternatives. So you want to make sure that you're availing yourself of that. And when you mentioned the state historic tax credits, a number of years ago, I did write an article for the Journal of Tax Credits on the importance of state historic tax credits. And in that article, I pointed out how Tennessee has been trying to get a state historic tax credit, and that if you look at the states around Tennessee, they all have a lot more development per capita because they do have a state historic tax credit. And it just identified how significant having a state historic tax credit is to historic preservation in a given state, which also, in a backhanded way, shows how the federal historic tax credit, for a number of reasons, has slightly diminished in value over the last 10 plus years, which I enumerated in my Senate Finance Committee testimony in July, a year and a half ago. So I'm glad you mentioned the significance of state historic tax credits. So when I think about this, as the developer gets through the gating issues and says, okay, the development has the potential to generate federal and potentially state historic tax credits as well, the next question, of course, is how much? And when you think about how much equity can this generate, we first have to know the amount of the historic credits. And for this purpose, let's stay with federal. Let's not talk about the states, but if you could first talk about the amount of the calculation of the state credits, then I'll have a follow-up question on how the amount of federal credits translates in terms of federal equity.
All right, perfect. Yeah, this is following just along with the conversations I have with those developers, and always get that question, how much in tax credits can I generate? And so the first answer is the federal historic tax credit is a 20% credit on your qualified rehabilitation expenditures. So what is a qualified rehabilitation expenditure? Those are going to be the costs incurred to improve the building itself. So costs like acquisition, site work, and FF&E aren't going to be eligible for the historic tax credit, but the improvements to the building itself will qualify. Also, it's important to know that expansions outside of the current historic tax credit building will not qualify. So if you're popping the top and adding floors or expanding next to the building, any costs that fall outside of the current volume of the building wouldn't be eligible. And then beyond that, other costs that qualify, and sometimes developers don't realize will qualify, are soft costs, the interest expense related to the construction of the project, architect engineering costs, carrying costs can all qualify for the historic tax credit. And then there's also the ability to have a developer fee or deferred developer fee, which is very common and can help to generate additional historic tax credits. Those are some of the common items. And then there's a whole bunch of other subtopics within here where we can dig in on pre-incurred QREs that have been incurred by previous owners and is their ability to capitalize those. So lots of other fun discussion points on how much historic tax credit can be generated, but generally it's that 20% and then the improvements to the building itself.
Well, I'm glad that you mentioned the previously incurred renovation costs that can be acquired, because it ties into your earlier observation about the fact that a developer should contact you as soon as possible and maybe before they close on the purchase, or at least the contract to purchase of the property, because you, as part of the purchase of the property, you probably want to carve out whatever costs that you might be stepping into the shoes of for acquired QREs. You might want to be enumerating in the contract, which then in a backdoor way helps with you determining meeting the substantial renovation rehabilitation test. But anyways, I'm getting into the weeds. All the areas that we can go to. We've had other podcasts on, and I'll have you back to have more additional items for the more advanced, but it just highlights the number of intricate issues at play here to maximize the amount of those credits. So assume for the moment, we have this rough estimate, and let's assume it's going to be $1 million of historic credits. That's small, but just for purposes of having a discussion here, you have $1 million of historic tax credits. How does that translate? How much does that mean, that $1 million, in terms of roughly the gross equity? And when I say gross equity, it's how much in cash will I get from an investor in a rough basis upfront or through the closing development process. And how does that relate to what I like to think of as the net equity? When I think of net equity, I think of I'm getting this gross amount, but bringing in a historic tax credit investor has other effects on the total project costs as well as sources of capital, such that when you're running a model and then you rerun the model with the credits in, your sources and uses are going to change based upon that. And you can then end up doing a before and after to get like a net equity number. Now, clearly we can't go into all of that on this podcast, but if you could just share some of the considerations in that, because it's never going to be, the benefit's never going to be more than the gross. It's always going to be something less than the gross. The question is, how much less?
Sure. That's a great way to frame it, Mike. So, saying you've got $1 million of federal historic tax credits. So the federal historic tax credit is claimed over 5 years. So it's important for a developer to keep in mind that if they have a historic tax credit investor that's going to come in and pay for those future credits, that investor is getting the benefit of those credits over a 5-year period. So they're generally paying less than $1. I would say 80 cents might be a good estimate, and we see projects that receive less and receive more in equity than 80 cents. But for this example, we'll say 80 cents, so $800,000 in potential tax credit equity. Now, typically what we see from historic tax credit investors is that 25% of that equity would be contributed at the financial close. So that would be available to fund construction, and then the remaining 75% would be funded after the placed in service date. But there are opportunities with bridge lenders and other financing sources to help bring some of that 75% of equity to the closing table and help fund construction. But so starting with that $800,000, that's the potential equity that can come to the project. There's also other considerations when bringing in a historic tax credit investor. For instance, there's usually a preferred return that they're looking for that might be 1 to 2% of the equity that they've contributed. So if that were 1% of the $800,000, they'd be looking for $8,000 annually, which reduces the overall net benefit of the historic tax credit. And they also may be looking for some additional cash flow on top of that, which is a consideration for these historic tax credits in general. I'd also highlight when reviewing term sheets, there's a plethora of items to consider, including tax structuring, the amount of reserves, contingencies, and other kind of nuanced historic tax credit items within these historic tax credit term sheets to be reviewed. So again, all the more reason to have us involved early and help developers sort through the complexities with the tax credit equity that's available to them from the historic tax credit developments.
Great. Thank you for all of that. And I'll just say that what you were focusing on there is how the gross equity kind of flows into the net equity with respect to the sort of cash contributions. And when you pull the lens back a little bit, or actually, let me also note that not only is the historic tax credit claimed out over 5 years, it's also in essence a taxable credit. So the fact that it's taxable in of itself also reduces the value, so that when you mention the 80 cents plus or minus, it's basically I'm taking it on over a 5-year period, plus it's in essence a taxable credit. And I'll leave it at that. Also, in addition to looking at that on the equity side, by going down the historic tax credit path, there's obviously additional costs dealing with the Department of Interior and things of that nature. The structure that you're creating might have additional ongoing operating costs. The fact that you're going to get your renovation certified will likely lead to some higher project costs, because there'll be some decisions that you're going to make that you might not otherwise make because the Department of Interior sort of requires it, as well as some of the design might be such that it has an impact on your future operating income. People always talk about windows in historic properties, and I don't want to go into all the details there, but just know that as you're developing your budget, that's the importance of having the experienced architect with historic properties, so they know how your development design might be altered in order to qualify for those historic credits, which is one of the reasons also why, when you layer in the state credit, the combination of those two make it much easier to overcome some of these other issues than the federal credit on a standalone basis.
Yeah, that's right, Mike. Going back to those earlier gating items when you're talking about the deal size and state historic tax credit, you can see all these things that come in as transaction costs and design costs, and how having a deal of a certain size is all the more important in order to absorb those costs.
So we've discussed the financial considerations. If you could share some of the other considerations of having an historic tax credit investor in the transaction. You mentioned the credit's claimed over 5 years. So obviously the investor is going to stay in at least 5 years. So you're going to have a partner for that 5-year period. But if you could discuss other, I'll say non-financial, but ultimately everything's financial, but non-directly financial considerations that developers should be thinking about when they do bring in an historic tax credit equity investor.
Sure. Thanks, Mike. So the 5-year compliance period is also a 5-year recapture period. And so that's one question I get very often. Hey, what if I want to do this rehab and sell my property in year 2? What is the impact of that? And so that would cause a recapture of the historic tax credit proportionally based on the amount of years you've completed after placed in service. Each year burns off 1/5 of that recapture loss that you would have. And when you have a historic tax credit investor in place too, they're going to have some oversight over that too, if you're going to have the ability to sell the projects. That's a consideration that I like to point out to first-time historic developers, but maybe experienced developers, that this is going to be a consideration if they were planning to have a quick sale and had to return capital to investors or things like that. Another point that comes up often is that a historic tax credit investor will usually want what's called a subordination and non-disturbance agreement. And so this effectively creates a way that the lease that the historic tax credits are passed through, that lease can't be disturbed for the compliance period. And it's an important aspect to bring up early on these calls because developers may be having conversations with their lenders and be going down the path of getting a loan set up for their development. And if they plan to use historic tax credits and monetize them with a historic tax credit investor, they're typically going to require that SNDA. So having that conversation early on, understanding that SNDA, and then introducing it to their lender early on in the process before they've gone through their loan closing is a very important aspect to consider.
And I just would note with respect to the SNDA, that's all about the recapture and the continuing to claim the credits, because an investor's coming in, they're really not focused on the cash flow from the development. They want the tax credits, and they want to know that the property will be in service for 5 years. And then the consequence, they don't want, if the project hits a hiccup, that the lender just comes in and takes over the project such that they lose their credits, the feature credits, and have recapture of a portion of the ones that they claimed. So that's the significance of the SNDA. And I'm glad you mentioned that, because that's definitely one of those non-financial considerations that you need to be teasing out early to make sure that the lender is on board.
Thanks. One other question I typically get is, what is a closing process like for the historic tax credit? And more market rate developers may be used to closing on loans, getting into their construction within a month. And that's not the typical for a historic tax credit development. So what I'm usually telling first-time historic tax credit developers that it's probably going to be a 6-month process to close with a historic tax credit investor. And usually that's made up of first getting the developer, getting their head around how the financing with the historic tax credit affects their cash flows, their overall structure of the deal, and then exploring potential historic tax credit investors with them. And then once they've gotten term sheets from investors, usually it's a 60 to 90-day close process. So you are looking at about 6 months to close and get historic tax credit equity into a project.
No, thank you for sharing that. And in some of your answers to the earlier questions, you mentioned a lease pass-through. And I'll just share with our audience that our former partner, who's since retired, Tom Boscia, and I did do a podcast in the past on the different types of structures between lease pass-through, straight-up equity, and the like. So I'll include a link to that podcast and not go on that tangent here in terms of the different structures there. And I'll also note, another plug for another podcast in the past, we also discussed the term sheet and some of the key items to be negotiating in a term sheet for historic tax credit equity with an investor. And the purpose of that podcast was just to share that in that initial term sheet, try to identify as many of the issues that could be an issue when you go to close and you go to negotiate the partnership agreement. And your point about the SNDA is a classic example of something that if that's going to be needed, which it probably will be, identify that in the term sheet so you can be discussing that with other parties, which is also part and parcel of on something like this. You want to share, you can't share too much with too many people because what might not be an issue to you might be an issue to somebody else. And you want to make sure that you're sharing as much as you can with as many people as possible, because as issues come up, generally we've seen it before and there's a solution, but the earlier you identify the issue, the easier it is to put a solution into effect, which I'm sure you're shaking your head.
Yes, all the time. The earlier we can talk about these, the better, Mike.
Yes, I won't ask you to share any horror stories, but I'm sure there's a few where you were like, if this had been surfaced 6 months ago, it would be a lot easier to address than right now.
That's right.
So if a historic tax credit developer does go through this sort of initial call or calls and decides it is worth perceiving, please describe some of the initial sort of services and ongoing services that you would end up providing to the developer as well to the partnership that's doing the renovation.
Sure, Mike. When we decide to move forward with services, a lot of times we're doing a phased engagement with the developer. And so the phase one is really like from this call moving forward, and we might do like a preliminary financial forecast. And that preliminary forecast is for the benefit of the developer to help understand if there's going to be the lease pass-through structure, how that structure affects them and their finances, but also take their pro formas and put it in a format that is familiar to historic tax credit investors. So in that phase one, we're really building out like a preliminary model, doing consulting, helping with these issues that we've flagged throughout this podcast, and then introducing their deal to investors and helping them through that term sheet process is part of what we can help with during that phase one. The second phase, we would go to a full financial forecast. And that forecast is generally required by historic tax credit investors to close on any of these historic tax credit deals. We do that as part of our services, and it acts as a blueprint for basically the entire historic tax credit transaction, from the construction through all the operations through the compliance period. So all of that's really laid out and aligns with all the historic tax credit documents that will be part of this closing. And we'd issue a final forecast on the closing date for the historic tax credit transaction. So those are our early services that we do prior to placing in service. But once they place in service, of course, as a CPA firm, we can help them with audit, tax services, and then all the way through the eventual unwind of the historic tax credit investor structure. And always very rewarding to see a deal where you help them on an introductory call like this, and then help them all the way through their eventual exit. So those are some of the services we can provide, Mike.
And maybe share your thoughts on the need for a cost certification with respect to the amount of the historic credits that'll be available.
Sure. So that's another service that we can provide, where we basically are doing an audit of the construction costs that have been incurred and helping to determine what is QRE eligible and what will generate the historic tax credit for the developer. So again, another service that we can provide, and it's generally required by historic tax credit investors.
Exactly.
There's no IRS requirement to actually have a historic tax credit cost certification, but all historic tax credit investors require them. And then there's also, if you're getting a state credit, some of the states require them as well. So that's another aspect.
Great. Thank you for that. And I wanted you to emphasize the fact that virtually all, if not all, and that might be something where you could say all, but certainly all of your traditional historic tax credit investors will want that. And as a practical matter, the developer should want that too, because it's such a critical part that you want somebody else looking at it and opining on the amount of the credits that are going to be claimed. Before we wrap up, John, please let our audience know anything else that you want to share in advance of bringing this podcast to a close, and in advance of them potentially listening to a handful of other podcasts that go into some of these issues in more detail.
Sure. So of course, call me early. It's such a pleasure to work on these historic tax credit developments and see how much they can benefit their communities, how impactful the historic tax credit and the state historic tax credit can be to these developers and getting projects completed. So it's a real joy for me to work on those. I look forward to those calls and to being involved. And then would also note, I don't know if you're going to touch on this later, but we have the Historic Tax Credit Conference coming up in St. Louis, which I think is October 9th and 10th.
8th and 9th.
8th and 9th. And look forward to seeing folks from the historic tax credit industry at that event as well.
And I'll echo that about the Historic Tax Credit Conference. We're looking forward to going back to St. Louis. We have an office in St. Louis, and we like holding events there. So we will have our Historic Tax Credit Conference there October 8th and 9th. Please register early. We'd encourage you to register. And if you do end up going to the event, please make a point of saying hello to John and me. I always look forward to our annual Historic Tax Credit Conference, which we had in Nashville last year. And
Cleveland.
What was that?
It was in Cleveland last year.
You are correct.
I would remember that.
No, you are correct. It was in Cleveland. I was thinking of our affordable housing conference in Nashville last year. I was mixing it up. So thank you for the correction.
You go to a lot of conferences, so I'll let you off the hook for this one, Mike.
No, I enjoyed that conference, and my room at the hotel looked over the Cleveland football stadium, and I enjoyed jogging around it the Friday morning before attending the conference. But I digress. Before we get to the off mic section, where I want to hear your shout out to our audience, please, if you're enjoying watching, if you're enjoying listening to the podcast, please subscribe. Please tell your business associates about it. And please also take a moment to like the podcast. By liking the podcast, you increase our visibility and help encourage us to keep providing the podcast free of charge. Also, if you have any thoughts on future shows in terms of topics we should cover, please send an email to contact@novoco.com. And some of our more astute listeners will know that is a change from our previous email address. So please send an email to contact@novoco.com. And I will include contact information for John in today's show notes, along with the article that was in the Journal of Tax Credits a while back on the importance of historic tax credits. I'll also include a link to my Senate Finance Committee testimony. I'll include a link to the podcast and the term sheets and types of structures, as well as a few other items that I think are relevant to our discussion here today. Now, let's go to our off mic section. And this is always brief, but we get to use this to give a shout out to others working in the tax credit and tax incentive communities. We like the ability to highlight professionals worthy of recognition. John, who would you like to shout out?
Thanks, Mike. So I'm going to shout out Patrick Robertson and Michael Phillips, who are part of the leadership of the Historic Tax Credit Coalition. And for folks that don't know, the Historic Tax Credit Coalition is a nonprofit advocacy organization that helps to protect and improve the historic tax credit and also works in other aspects like improving the state credits, MPS process, et cetera. So great organization and appreciate their leadership and would encourage folks that are involved in the historic tax credit industry to look into it and be a member.
Thank you for that shout out. I echo that shout out as well and give my own personal thanks to Patrick Robertson for all that he's done on behalf of the historic tax credit. His client is the Historic Tax Credit Coalition, as you mentioned, and Michael Phillips is with the National Trust for Historic Preservation, and he is very active with the Historic Tax Credit Coalition as well. And one way that our listeners can stay engaged and learn more about the historic tax credit is to join the Historic Tax Credit Coalition. So I will include a link to that as well in today's show notes for folks to consider joining and supporting the cause. I can't encourage folks enough to join the Historic Tax Credit Coalition. They're the leading advocate for the preservation of the historic tax credit itself, as well as increasing its utility. Many of our audience may remember back in 2017 when the historic tax credit was under threat of repeal, and actually a House bill was passed that did repeal it, but fortunately, thanks to the efforts of Senator Bill Cassidy and many others, it was preserved in the final bill, the Tax Cut and Jobs Act of 2017, albeit moved from a 1-year credit to a 5-year credit. But I digress. Hopefully what I just shared might encourage you to become a member of the Historic Tax Credit Coalition. And with that, John, thanks for being on the podcast today. I look forward to your next visit. And to our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.